This is a podcast by the Straits Times.
When you get your information, go do your homework. I always reiterate to young people, do your homework. Don't go with groupthink. Don't just buy because somebody, your best friend, is telling you to buy this or buy that. Listen, go back, do some homework, maybe ask some experts. There are lots of analysts, investment bankers, brokers who can advise you. If you don't want to crunch the numbers, there are others who will crunch the numbers for you. So ask around, check around, don't rush. Never rush to make money. Money will come to you if you are patient, diligent, and deliberate.
I think we can agree that 2024 was a wild year. Many elections, much uncertainty, and turbulence in the global economy. And so many changes in the world around us. But how does this affect young investors and the stocks that they pick? For those who wish to do stock picking, how do they go about it in this volatile world that we continue to live in? And as we go into 2025, which are the industries that show promise? Hi, I'm Suen Tan, and you're listening to Headstart On Record. In the studio with me is young investor Troy Cheng. I also have with me veteran market watcher and stock picking guru Ven Sreenivasan. Welcome to the show. Okay, so firstly, Ven, could you tell us more about what stock picking entails and what are your top 3 do's and don'ts in stock picking?
Okay, when you're buying stocks, you're actually buying a part of a company, part of a business. So you need to take a medium to long-term view. So stock picking entails some analysis. There are headwinds, tailwinds in the industry. You got to do a bottom-up analysis of companies and all that. When I do stock picking, I look at who the dominant players in industries are. Top 1, top 2, top 3. Look for companies with network advantage. In other words, customers will not migrate out of this company. The company will be there for a while. Also look at revenue and earnings potential, at least 30% year on year. Return on equity, about 15%. And of course, one of the most important things is positive cash flow. And if you ask me about don't buy into debt-laden companies. If the gearing is high, 0.8 times or over, be careful. Okay, debt over equity. Avoid companies with negative cash flow for several years. Avoid those that are slowly losing market share. You think back of companies, I don't know, you may be too young. There's a company that was called Nokia mobile phone, Kodak film, all disappeared, lost market share. You got to watch for the business, how they're doing. And also, when you stock pick, don't listen to people all the time. Your friend will say, hey, buddy, this is a good stock, man, going to go up. Do your own research and stick with what you find for the long haul. That would be the basics in stock picking.
That's interesting that you say that because I think for now, for young people, word of mouth is quite important, right? So how much weight do you think you give to that?
I think you should listen, but don't take everything in. Do your homework. Of course, word of mouth, you'll get tips, right? People tell you stuff, people who know a bit more than you. But go back and check the facts. Somebody could be telling you to buy a stock because he's loaded up on it and he's probably going to sell when you're buying. So be careful of that, Don't be overly influenced by what you hear, but also listen out. That's where you get information from.
Okay, yeah, that's very helpful. So for Troy, as a young investor, how did you get into stock picking and why do you decide to do it?
Okay, I think the main goal is just like any other people, is to build wealth. And then the first thing I got in touch with is actually equities when I was 19 years old. It all started with losing money and not making enough profit after investing. Hence, I went to do a self-reflection on what went wrong and how to break out of this cycle. So I started doing homework by Googling and understanding the financial markets better by reading different resources. I realized there's a difference in investing and trading. Opportunities are everywhere. So investing is more of a longer time frame and trading is more of a shorter time frame. So the key thing I've learned so far is having some bases before placing an investment position. So the basis could be from fundamentals, technicals, or in terms of valuations.
Correct. I think that's the way to go. I mean, you are spot on in the way you approach these things. Always pick businesses you're confident in based on the metrics that you just described.
Yes.
That's important. You got to look at the potential earnings, projected earnings of the company. And also, somewhere down the road, you also have to, I guess, look at the intrinsic value of companies. There are companies that are undervalued. There are companies that are overvalued.
Right.
Some of them is just fluff. They're just going up because everybody's talking about it, right? And ultimately, the bubble will burst. So I think what you're saying is absolutely true. Use basic, very strong metrics to evaluate companies. And when you pick a stock, what are one or two things that you really look at?
Okay, the first thing I would start is looking at P ratios, PB ratio, and the last thing is dividend yield. Because in any case that I go wrong, at least I'm getting something out of the stocks that I pick. Probably the yield that they produce annually. Yeah.
Can you explain what the PE ratios are, just briefly?
Okay, for PE ratio, it means price to earnings. It's trading at how many times the earnings. So how do I compare it within the companies is, within a sector, there's some sort of ideal number. So we just do a peer-to-peer comparison. Probably, let's say, it's a tech stock, so we compare to a tech PE ratio. So that's for PE ratio. And then PB ratio is price to book, which is how many times is the stock trading to its book.
Book value, yes.
Yes, correct. So by looking also at the same method as PE, we compare to its peers in the tech sector or the banking sectors. We compare and then see a gauge whether is it underpriced or overpriced.
Again, you're absolutely correct. I mean, if the current traded price of a stock is below 50% below its intrinsic book value, you know that you have a safety margin if you buy it, a 50% safety margin,
yes.
right? But there's this thing, okay, you asked what PE is. In simplest form, price earnings of 5 means 5 years of earnings to reach your price, okay, the price to earnings. If it's 10, it takes you 10 years to get there. But, don't buy a stock just because the PE or the price earnings is low. You also have to look at the growth of earnings. So high PE could be actually a good buy, if the earnings growth is much higher than the price, A low PE stock could be a loser if there's no earnings growth. And the bottom line is all about doing your homework, knowing how to do your analysis. Go online and learn some of the techniques, and then you would equip yourself to analyze companies better.
Yeah, so for Troy, where do you get your information from in your personal daily life? Because there are people who go on TikTok, for example, to look at what stocks to buy, right? And I think we have discussed a bit of how that is maybe not really the best way, or you can get information that is very subjective or very biased to the person who is presenting that. So for yourself, where do you get that from?
Okay, ideas can come in any ways. It can be in news articles or commentaries. The Straits Times or the Business Times do give good articles and maybe...
Thank you for mentioning the Straits Times.
Yeah, it does give good perspective of the market. Sometimes we don't really observe it in our day-to-day life, and then someone else wrote an article and it opens up your perspective.
Yes.
So, yeah. So I categorize into different time frame for all different methods for my investment. So it starts with long-term investment, mid-term investment, and short-term trading. So I have a pool of money, and the method is different. So for long-term, I'll use fundamental analysis. So like I shared, I'll look at the 3 key things I mentioned just now. It's PE, PB, and dividend yield. So with all this, I'll gauge a price alert for different stocks and let it notify me when it touches a certain price level. So for your info, when a stock price is low, the dividend is normally high. And then I can give you an example, like during Chinese lockdown in 2020, the stocks for Chinese banks were looking attractive low, and the dividend yield was around 9% per annum back then. So I did take the opportunity and grab some that time. Yeah. Right. So in terms of midterm, it is mostly thematic play. So stock ideas might appear anywhere, so I do read articles, and then I catch a trend, And then those journalists will give me a good analysis on sector rotation. So for example, banking stocks are benefiting from high interest rate environment. Maybe out of nowhere, you did not have this idea, but someone did mention to you. And then it might spark your training thoughts. And then maybe I should try this thematic play. And then as interest rate comes down, maybe industrial stocks might be a potential next sector. So it's really about different stages of an economic cycle. So maybe commentaries might help you to spark those thoughts.
Exactly. I mean, that's how you get information, right? Then you do your homework.
Yes.
Correct. I mean, in times of high interest rates, banks benefit. In times of low interest rates, REITs benefit. Leveraged companies, they would start benefiting. Industries which have borrowed money or whatever.
Correct.
Properties and all that.
Yes.
So you're correct. And when you get your information, go do your homework. I always reiterate to young people, do your homework. Don't go with groupthink. Don't just buy because somebody, your best friend, is telling you to buy this or buy that. Listen, go back, do some homework, maybe ask some experts. There are lots of analysts, investment bankers, brokers who can advise you. If you don't want to crunch the numbers, there are others who will crunch the numbers for you. So ask around, check around, don't rush. Never rush to make money. Money will come to you if you are patient, diligent, and deliberate.
True.
This is such good advice, yeah. And I think you have already mentioned some of the industries that you can look at, right, in certain interest rate environments or depending on the economic cycle. So for 2025, which are the industries that you are looking at?
2025 would be, I read a lot. So from what I read, the industries which seem to be on the leading edge of investors' portfolios tend to be technology. If you're on Wall Street, you're looking at the Magnificent Seven. You're looking at AI-related stocks. But this year and next year, you're going to see about billions being spent on AI. What you need to look is who is receiving this money, who is the beneficiary of this capex. This would be the place that you would be looking at in the technology area. Among the other techs, the Magnificent, you got Google, Alphabet, Microsoft, Amazon, Apple, Meta. These are companies that are going to be there for a long time. You cannot switch out of it. You will need your Microsoft, you'll need your Google for a long time. So you'd still buy that for a long term. But there are also consumer discretionaries that you can look at. For example, fashion brands, high fashion brands, the LVMHs of the world and stuff like that. And healthcare. Healthcare is always something that's interesting as new technology comes to the fore. So if you ask me what I'm looking at, these would be areas we're looking at. But I'll tell you something what I would avoid as well. I would avoid energy. I would avoid commodity. I would avoid real estate. I would also avoid motoring stocks. Why? First, they face high competition. Second, they're cyclical businesses. Third, high capex spending. Fourth, they all have weak pricing power when they compete. And as a result of that, they will have compressed margins. So go for companies that are on the winning edge, which in 3 years, 5 years will still be there, will still be growing, will still be earning, rather than companies that are struggling all over the place with competition and erratic earnings, margin compression and stuff like that. So that would be how I would pick my stocks without specifically naming a whole bunch of them.
Yeah, that's very helpful. So for Troy, yourself, this year, what industries are you looking at?
I think for US, Donald Trump is taking leadership for the next 4 years. So from what I read from commentaries, Trump's pro-growth and pro-business agenda may boost the US market in 2025. His tax cuts would have positive effects on businesses and consumers' spending, which I also agree from what Ven said. There might be potential growth in the consumer discretionary industry. So for China, I come across an article saying that the world has recognized China's remarkable achievements in pursuing high-quality tech development, such as AI and quantum tech. So this was quoted from President Xi Jinping New Year message. Overall, China is keeping their leadership in the tech sector. As such, I focus more on large cap and index-heavy Chinese tech companies listed in Hong Kong.
Correct. I would agree with you on that one. I mean, technology is going to be front and center. Whether you're talking China, you're talking Wall Street.
Yes.
I mean, the leading tech stocks, you won't go very far wrong, especially if they are run well and they have, innovative products coming on stream. But like I said, quantum computing you mentioned, which is something that is going to be big in time to come. But I am actually also looking at the huge spending, there's 200 billion spent on AI last year. In the next few years, it's going to be over, I don't know how many billions are going to be spent. So I'd also like to see where it's being spent. So there are going to be beneficiaries on the other side, right, who are going to get. So look at those companies.
Yeah, and we've already shifted from the Singapore stock market to like China to the US, right? And I think we have spoken a lot about the trend of like young investors, especially looking further afield for their investments, sometimes even their first stock investment, and it's in the US market. So, for both of you, like what are some of the differences, right, between the Singapore and the US market? Because I'm sure investing on the SGX and investing like in NASDAQ is a whole different ball game. Like, how do you really prepare for the risk associated with that? Or what are some of the things that young investors should know before they go out there?
Okay. The US stock market is a huge ocean, right? You got to be wary of bouts of euphoria and pessimism that sweeps Wall Street every now and then. Okay, like yesterday, for example, this is early January. Suddenly you saw a whole bunch of quantum computing stocks being sold down, okay? Just on the remarks of a CEO of a chip company, right? But also stay abreast of corporate developments and announcements by companies. Try to access research analyst reports on companies that you are investing in. If you are in Singapore, you are investing in a market which is far away on Wall Street. Always be aware of that. Okay, and Wall Street is very much different from Asian stock markets. The US markets operate entirely on a buyer beware basis, caveat emptor, not a merit-based disclosure rules basis like the Singapore Exchange. Here we are very strict. So, if you have a passion, study the financials, do your homework. All right. And if you are unable to actually do your homework on individual stocks on the US market in particular, look at ETFs, exchange-traded funds. There are many on the Dow and S&P. You have QQQ, you got MGK, SMH, all the semiconductor ETFs. So it depends. Each person is different. Each person has different capacity. Each person has different amount of time to spend on actually analyzing stocks and shares. Singapore market is more straightforward. There are lots of analyst reports out there.
Right.
We are closer to the ground. You know what's happening. And, you can actually get in touch with people. You can attend AGMs and stuff like that and actually hear the CEO and CFO talking about their company. It's a very different ball game here. There, remember, it is there. Here, you are here. So you need to adjust to that.
So Troy, after hearing what Ven has said, do you hold any US stocks, and what are like some of the precautions you take or the things that you ensure that you know about before you do that?
Actually, I'm more sticking towards the news flow of the latest trend. So for myself, I'm currently cautious on the US stocks and it's reducing US weightage in my portfolio. So because of fundamentals, the price to book of S&P 500 index have reached very high above their 10-year averages. Now, in terms of valuations, I'm not the only one, but I noticed global analysts are pricing their target price quite tightly with limited upside.
Correct.
So another thing that made me uncomfortable was the number of US rate cuts. To my understanding, the markets are pricing that there will be potentially 2 rate cuts in 2025. The current yield is at 4.5%, which is still at elevated level. So which means borrowing costs will still be high for US companies, and it may potentially hit the revenue of the company. Therefore, during coming earnings seasons, there will be increased market volatility. But on the flip side, China has been lowering their loan prime rate in hope to lower borrowing costs and stimulate the economy. I read a piece of news recently saying that interim dividend paid by Hong Kong listed Chinese firms reached around US $16 billion for the fourth quarter of 2024. And the number of share buybacks have also seen a record high, signifying upside potential in terms of stock price. So like I've shared, I'm more looking towards and opening up my option for Hong Kong stocks because of attractive fundamentals.
I would agree with you on that.
Yeah,
I mean,
thank you.
a recovery in China, which I personally think should come in the next, not this year, perhaps late next year. You would see the likes of Tencent, Xiaomi, Alibaba, and a lot of Chinese stocks picking up. You'd also see a consolidation in the auto industry in China. And the big player emerging would likely be BYD, right? But you just reinforced a point I just said about Wall Street. A lot of euphoria balanced with a lot of pessimism. So you don't know, one day you may get up and Wall Street is up. One day, next day is down. For no reason, nothing has changed. The weather is still the same. The sun still rises and sets. So Wall Street is driven by this kind of euphoria news and stuff like that. So you got to be very careful. If you're getting into Wall Street, pick the right stocks after doing a lot of homework and stick with it. Don't get nervous and don't panic and don't go jump off an HDB building because your stock fell 5 cents the next day. You got to be strong. You got to trust your judgment and stick with it. This is not a one-night stand, all right? It's a long-term commitment when you buy stocks.
Yeah, I think a lot of what you said is more about holding for the long term, right? Because we do know that there are also the sort of young investors who they want to buy something when it's low and then they immediately cash out when it goes higher or when something happens in the market.
Yeah.
But what do you think of that sort of technique?
You mean buy low and
Sell high.
Sell high.
Sell
yes,
high.
Yeah.
buy low and sell high is ultimately the name of the game, right? But what time frame are you talking about? You're not going to buy low, sell high in 1 week or 1 month. If you hang on to S&P, you'd probably be up 24-25% over a year. That's 52 weeks. So, 52 weeks, you make 24%. That's a good return. If you buy ETFs, you make 10 to 20% a year. That's okay, If you're a 23, 24-year-old, by the time you're 40, you'd probably be a millionaire. That's long-term thinking. That is diligent investing, long-term investing, and getting your picks right, doing your homework. So there's no such thing as quick money. Very few people make quick money. You have to be diligent, smart, patient, and take a long-term view. If you are in your 20s, don't worry, you have a long runway. You don't need to make your millions and by the time you're 27 or 28. You can wait till you're 40, So bear that in mind. Just be patient, keep building and building and building. Use tried and tested formulas, which we just spoke about.
Yeah, and for Troy yourself too, you seem to be very level-headed, right, and clear-eyed about what exactly you're investing in, and you're quite careful. But do you see this among your friends and your peers as well, or what are the sort of investments that they're holding, and what sort of sentiment do they have?
Okay, I think around all my peers mostly are playing options, and I think they are quite sophisticated players at my age already. So they're probably putting some money just to bet on a certain upside or a downside. So it's a win or lose game. Yeah.
These are risky bets, derivatives, options, and all.
Right.
They are risky bets. You got to be very sharp. You got to be really plugged in. And if you have a full-time job, I don't know how you're going to do that, right? So for some people it works, but it doesn't work for everybody. So just because you got a friend out there making a lot of money on options doesn't mean that you will be just as successful. You take your eye off the ball and things go haywire. Then what do you do? So I, for one, would advise a young person who's starting out to pick up good stocks, good companies that will be around for many, many years, companies that are seeing strong growth, companies which have a strong economic moat. You know what's an economic moat? That means you're well protected, your business protected. Nobody can come and just take it away or get into it so easily. Branding is there, markets is there, your market power is there. So these are the companies. Don't jump into derivatives like options and others unless you really know the game. This is at a very high level. And there are lots of sharks out there who will have you for lunch and dinner if you don't watch out.
Yes,
Yeah.
true.
Would you also recommend someone to start in the Singapore stock market before going overseas?
I would say yes. You know, we always talk about the Singapore market being moribund and boring, but there are very exciting places below the surface. You look at our TLCs and GLCs, they are all world beaters. And then there are mid-cap companies that are paying very good dividend and high growth, very well led by very good management teams. So Singapore has got its unpolished diamonds. Look for these, buy these. And in Singapore, you get good yields. Last year, the STI alone yielded 4.9% in dividend yield. REIT's side was 7% in dividend yield. And a lot of mid-caps gave out at least 5 to 6%. This is a great market. I mean, if you are looking at dividend yield, you can buy and keep. Nothing really bad happens because it's a very well-regulated market. The other thing about Singapore is this is a country which, in very choppy geopolitical seas, is a safe haven. A lot of funds come into Singapore. Right now, not much of it is going into the market. But the Monetary Authority of Singapore has set up a committee to look into rejuvenating the market. If it pulls some rabbit out of the hat, you could see liquidity pick up quite quickly. And I've been in this business long enough to see the Singapore market really swinging up very quickly. So I wouldn't discount the Singapore market. Yes, it seems a bit slow, particularly you look at IPOs and all that. But there's potential, there's a lot of value, a lot of companies are very undervalued, but are enjoying high growth. So yes, you should perhaps look at the Singapore market first before venturing abroad.
Troy, do you agree with that? Do you think that SGX can be exciting to young investors?
I think it's mostly for the long-term investment, and it will be interesting for a young investor.
Yeah, I mean, like I said, if you're looking at yield play and all that, it's interesting. Look for corporate developments, Like, for example, a couple of days ago, there was one company, Centurion, which said it's going to put all its assets into a REIT. And suddenly you see a lot of activity on the stock going up and all that. There are other companies which are very cash-rich, are going to make big payouts. So there are companies with strong economic moats, with strong businesses, with very good CEOs. There used to be Sembcorp Marine, which merged with Keppel O&M, and they have a company called Seatrum. It's a global leader in energy services. So we have our fair share of very good companies. Our banks are amongst the best in the world, right? We have seen super-duper growth. So there are diamonds in the rough in Singapore, I would say.
Yeah, that's very encouraging to hear, right? Especially when we have all these reports about how tepid it has been, especially in terms of listings. So that is good. Now, I've come to a more personal question, which is, what has been your worst investment mistake so far? So I guess you do not have to name exactly what it was you bought, but maybe you can give an idea of how much you lost and what happened. Troy, maybe for you, do you have something?
I think my worst mistake so far was my initial part of my investment journey. So, because at the start you have this small amount of money. So as you work and then you have a larger pool of money, but then you forgot, actually, the larger amount of money means your trade size is bigger. And in any case, if the markets was against me, so the larger trade size would mean larger losses. So I think this was my largest mistake. And therefore, I learned along the way to have a proper risk management and put a proper trade size that I'm comfortable losing in any case that markets go against me. Yeah.
How do you feel when that happened though? Like, do you cry yourself to sleep or something?
I think I did not cry, but it just make you unhappy throughout the day. Yeah.
Spoils your day, spoils your week, spoils your month, right?
Yeah, true.
Yeah.
Yes, I guess for Ven, maybe you might have something even bigger since, you've been longer in the business.
In my early days, I wasn't very savvy in the way I bought companies. I listened to friends. I bought into one or two stocks of companies which were losing market share, earnings were erratic, margin compression and all that. And the stock price kept coming down. And ultimately the companies, they stop trading. So you lose all your money there. Fortunately, it's not big money, but it was a lesson learned. So that's why I always look at growth, PE, market, the positioning, the branding, how strong this company is in what it does, its dominance, its economic moat. These are things that are important to me now. So I'm not going to buy into a stock just because a few days it started running up. Somebody could be manipulating it upwards. Who knows? And then you jump in and everybody sells and you're stuck holding the baby, right? And so these are things you got to watch out for. Never get caught up in euphoria. Do your homework. And the other risk in stock picking actually is overly concentrating on a single stock. Yeah, you got to diversify, okay? So, if you're all into one sector or one type of stock, if that sector goes bust or that stock or that company goes bust, you're going to suffer a significant loss. So you must be diversified. So don't buy into stocks of companies which are not making money, okay, whose profit flow is erratic and unpredictable and has no competitive advantage in the marketplace, okay? Again, Kodak and Nokia. So you may be a champion today, but in a few years you may lose everything. You may not be up to it. And also don't pick a stock just because your buddy says it's good. Okay, do your own homework. My advice would be stock market investing is a long-term endeavor. Okay, so and always go for strong and dominant place.
Were you worried when your kids first started investing?
I found out the hard way when they came to me for more money.
Oh dear.
But they are savvy. They read a lot. They go online a lot. They subscribe to various research, offshore, onshore and all that. They pay for research. And I'm quite confident. In fact, on instance, they gave me advice because they read a lot on the companies they are interested in buying. Of course, young people will always listen to your buddies and your friends and all. It is very good. Listen, discuss, but do your research.
Yeah, because sometimes I think when everybody's following a trend, it feels like there is a grain of truth in that, right? Like they're all following it for a reason or they're all buying something for a reason. Troy, how do you deal with all that, the social chatter?
For me, I don't FOMO because I don't chase the stock price. Honestly, it's quite dangerous to chase all this because I don't want to be the last one holding that baby. Yeah. So typically, I don't chase. Yeah. Whenever I hear, it's just a wind that passed by my ear. Yeah.
Okay.
Yeah, Troy made a very, very, very important point. FOMO. Don't get in, just because everybody is getting in. Because you may be the last one getting in, When everybody is going outdoor, you're getting through the indoor. And then you're stuck there. So, these are the risks. These are the standard risks. But, sometimes when we get greedy, we are chasing the big dollar sign. We forget these basic fundamentals. Even the smartest among us sometimes forget. And that's where we get tripped. You got to have your head about you. You got to be sensible. You got to listen, but you got to do your research.
Is there something to be said as well about controlling your emotions, right?
Yes. Control your emotions. Euphoria will always be there. Okay, a stock goes up 5% today, 10% tomorrow, 10% the following day. Wow, you get very excited. You think, I get in there, I'll make more money. Yeah, you may make money for a day or so, but you never know when, if you don't know why the stock is going up, you may be riding a very slippery slope. You must know why the stock go up 3-4 days. Is there fundamentals or a bunch of people pushing it or what, So that's the danger there. The danger of investing. It's very hard to make money, but it's very easy to lose money. If you take your eye off the ball. That's my advice to young people.
Wow, okay. Yeah, I think that has been a really enlightening and insightful conversation. Thank you so much. That's a wrap for this episode of Headstart On Record. Thank you, Troy.
Thank you.
And thank you, Ven.
Thank you.
It's been a pleasure talking to you. I'm Suen Tan. You can email us your thoughts on this issue or suggest another question you'd like to see me tackle next time on the show. You can also reach out to me on LinkedIn. And if you'd like to read my articles and the Headstart newsletter, all these links are in our podcast show notes. This podcast episode is edited by Amirul Karim. Stay tuned then. Thanks for listening.
Send your feedback to podcast@sph.com.sg. Find us on Apple Podcasts, Spotify, or within our Straits Times app. Thanks for listening. Do note, all analyses, opinions, recommendations, and other information in this podcast are for general information purposes only and are not intended to be relied upon as financial advice. You should not rely on them in making any decision. Please consult a fully qualified financial advisor or professional expert for independent advice and verification. To the fullest extent permitted by law, SPH Media shall not be liable for any loss arising from the use of or reliance on any analyses, opinions, recommendations, and other information in this podcast. SPH Media accepts no responsibility or liability whatsoever that may result or arise from the products, services, or information of any third parties. All opinions expressed by participants in this podcast are solely their own and do not reflect the opinions of SPH Media.